Hi and welcome. We're now in the basics of U.S. personal income tax class 3 deductions. This lesson is going to be focused on itemized deductions and the Schedule A form. So this is a continuation of our video series. Please feel free to reach us on YouTube if you found us by some other method. Lesson 5B, itemized deductions. What we're going to do is we're going to go through the Schedule A, the first section being medical and dental expenses. Then we're going to talk about how certain taxes that you pay are tax deductible, what interest that you pay is tax deductible, how to account for gifts to charity, and other miscellaneous deductions. So the first thing that we need to understand is that if the total of your itemized deductions is higher than your standard deduction, then you'll probably want to itemize. Both deductions reduce your AGI and lower your tax liability. You can report itemized deductions on Schedule A. The amount from Schedule A goes onto line 29 of Schedule A. The amount from line 29 on Schedule A is entered into line 40 of the 1040, and that line 40 is the same line you would use for your standard deduction. So it is an either or. You can't take both. I often have people who come in who have very few itemized deductions, and they say, well, I thought I could take this off in my taxes. Well, you can if you itemize, but it is much better and more advantageous to take a standard deduction if the dollar value is higher. So here we're going to go through an example. Tommy and Pamela are married but have lived apart the last 2 years. Tommy's return will be married filing separately, and Pamela will claim their 2 children and file as head of household. She will itemize her deductions. Tommy cannot claim the standard deduction and must itemize his deductions even if he has none, or if his standard deductions are less, or if his itemized deductions would be less than his standard. If Tommy itemized his deductions on his married filing separate return, then Pamela would have a choice of taking either the standard deduction or itemizing her deductions because she qualifies as head of household. One of the things that is a requirement is if you're married filing separately, the tax form does ask, is your spouse itemizing? If your spouse is itemizing, you as someone married filing separately is forced to itemize. And if you think about this from a tax code perspective, let's say that you have 2 individuals that live in the same house, they share the same basic expenses, they own a home, etc. They're paying real estate taxes. One of the spouses chooses to itemize on their return. They take all of the deductions and all the itemized deductions, and the other spouse is then claiming the standard deduction on a married filing separately return. You can see where there would be more deductions claimed by that household than there should be. This is the reason why married filing separately asks that question. If you are married and your spouse itemizes, then you must itemize. When you do itemize, there's a lot of different things that you can take, quote, off on your taxes. Medical and dental expenses if they exceed a certain threshold. Any taxes that you paid if they qualify. Interest you paid if it qualifies. Gifts to charity if they qualify. Casualty and theft losses. Job expenses and certain miscellaneous deductions. And then we're going to go through this in detail. This is what the itemized deductions form or Schedule A looks like. You see up here in the top, there's the medical and dental expenses, then the taxes you paid section, interest you paid section, gifts to charity, casualty and theft losses, job expenses where you did not receive reimbursement, and then there's a section here for other miscellaneous deductions. And then we add it up, goes into line 29, and this is placed on line 40 of your 1040. Medical and dental expenses. You can include medical expenses you pay for yourself and your spouse or any dependents that are claimed on the return. A person that was your dependent at the time that you paid the expenses and at the time that the medical service was provided. Any person you could have claimed as a dependent except that person received $3,950 or more of gross income or filed a joint return. So now that we have the ability to keep our children on our medical coverage until they're 26, what this is saying is that if the only reason why you couldn't pay could not claim that person as your dependent is because they made too much money, then you would be able to. So again, you're talking about immediate family relatives for which you are responsible. Medical and dental expenses that exceed 10% of your AGI are deductible. That's 7.5% if either you or your spouse was born before January 2nd, 1952. You may want to note to determine the 10% of your AGI before adding up all of your expenses to see if this is an amount you're likely to exceed. So for example, if you're somebody who made $40,000 this year, your medical and dental expenses would need to exceed $4,000 before you would be able to count it. And now it does include insurance premiums. So for some of us, that may be a number that's easily attainable. For others, if you are not actually paying your insurance premiums, if they're paid for by an employer and you're only paying copays, $4,000 would be a lot of medical and dental expenses for someone with a $40,000 income. Medical and dental expenses. Here's an example. We have Chico. He's 49 and his adjusted gross income is $25,000, and 10% of that amount is $2,500. He paid medical and dental expenses a total of $3,000, which he reported on Schedule A. He has $500 that would be deductible and go towards his itemized deductions. If his medical and dental expenses had only been $15,000, would he have any medical deductions on the Schedule A? No, because the $1,500 would be less than the $2,500, and so none of them would count towards his Schedule A deductions. These are things that you can and cannot include. Basically, you can include bandages, any type of medical procedures, prescription medications, anything that is prescribed by a doctor. Things that you can't include. You can't include, you can also include, and I think we're going to get into some more detail here on the specifics, if there's travel associated with your medical, even if it's just your mileage to and from the doctor or the hospital, dentist, etc. Things that you can't include. If you required babysitting or childcare while you were attending a medical event, you would not be able to include that. You can't include bottled water. If you receive reimbursements through a flexible spending account, then that's considered the money. You do not also get to include your flexible spending account expenses here. Any funeral, burial, or cremation expenses are not included. I do like the fact that they let you know here, any illegal operations, treatment, or medicine, if you have anything illegal, you can't put it on your tax return. Maternity clothes are not included. In surgery for purely cosmetic reasons. So if it's purely cosmetic, you cannot include it. If it is actually part of a medical or a health benefit, then you would be able to include it. So this information is available in your publication 17. Medical transportation, this is what I was talking to you. You have your choice. With most medical, you can choose either actual out-of-pocket expenses or the standard rate. And I'm going to check this real quick because I think our standard rate may have changed. Let me look real quick here. I was working on the standard mileage video here the other day. Let me see if I can pull it up real quick. I did change it. It did change. It is now 19 cents. That is correct. Last year it was 23 cents. So here you have Greg, who drove 1,000 miles for medical reasons in 2016. He used his car, and his actual expenses were $370 for gas, $10 for oil, $20 for toll and parking. Should Greg use his actual expenses or the standard mileage? So in this case, $370 plus $10 is $380 for his actual expenses. If he used the standard mileage, it would be $190. So he's going to use the $20 for tolls and parking go into both. So you would be able to count the $20 for toll and parking, with the 190 for the standard, as well as with the 380 for the actual. So the tolls and parking are counted for both. Medical lodging. You can include as part of your medical expenses the cost of meals and lodging not provided by the medical facility if all of the following are met. The lodging is primarily for and essential to medical care. Medical care provided by doctor is in a medical care facility, and the lodging is not extravagant. No significant element can be for personal pleasure, recreation, or vacation in the travel away from home. You can include as part of your medical expenses the cost of lodging. Oh, here's some additional requirements. The lodging expense is limited to no more than $50 per night per person. So if you're staying at an inexpensive hotel and near the hospital, and it's running you $120 a night, and it is for you and your significant other who is accompanying you, you would be able to claim $100 per night. Cost of living in a retirement or nursing home is deductible for yourself, spouse, or dependent if they are in the nursing home because of the availability of medical care. So this is where we get into a lot of the long-term care insurance, because this can add up very quickly. Home improvements not increasing the value of your home but required for medical conditions are deductible. An example there would be a handicapped shower or a handicap access ramp going to your house. Those could be included as your medical deductions. Insurance premiums that you pay for policies that cover medical care are deductible. Medicare B premiums are deductible when you put the information into most tax forms and you put the SSA 1099 information in. You'll see that the portion that's associated with Medicare D will automatically populate as a starter figure in your medical expenses on your Schedule A. Weight loss programs, they are deductible in any unreimbursed amounts that you pay for participating in a weight loss program, as long as it's not for the cost of purchasing diet food items. If you are just participating in a weight loss program to improve your general health or appearance, and it's not because of a diagnosis from a physician, it's not deductible. Stop smoking programs, they are deductible for the amounts you paid for a program to stop smoking, and what's not deductible is what you pay for drugs that you do not require a prescription. So if you're just getting an over-the-counter nicotine gum or prescription or patch, that would not be deductible. However, if you go to your doctor and you ask for assistance and they either prescribe medications or they put you into a program, then it would be deductible. So that's the end of the medical deductions. Now we're going to move on into the taxes that you paid. In order for a tax to be deductible by you, the tax must be imposed on you and must be paid by you during your tax year. So some of the things that you can see here, state and local, you have two options. It's either the income tax paid or the general sales tax, and we'll get into that in a little bit more detail. Any real estate taxes that you paid, any personal property taxes, if there's other taxes that you might have paid, you can list the specific type of tax. So deductible taxes would include your state and local income tax, any sales tax you paid, real estate taxes, personal property taxes, as well as foreign income taxes. You can elect to deduct either the state and local income tax or your general sales tax. That's what I was showing you, the two lines. Your state and local income tax are any taxes that are withheld from your salary during the year, any estimated payments that you made, and if you had a balance due that you paid for the previous year. So for example, in 2016, the money that was withheld from your salary during 2016 to pay your state taxes was actually money paid in 2016. However, you may receive some of that money back. So if you take the money off of your 2016 taxes and then you receive a portion of that money back as part of the deduction process, the itemized deduction process, that amount could be taxable in the next year. So remember back when we were talking about taxable sources of income, we talked about state and local income taxes or your refunds possibly being taxable. So you're taking it off in this section. And if you take it off and then you get money back, you would have to reduce it or pay the taxes on it the next year. If you did not pay enough in 2015 and you actually had a balance due in 16 and you paid an additional $200 to complete paying off your state and local income taxes, you can also include that $200 when you're doing your 2016 taxes. General sales tax, the actual local and general sales tax you paid if you choose to keep track of it, or there's an optional sales tax table and certain local sales tax tables as well, and you can use the table amount that's based on your AGI. So here we have Joanna, and she's single, and she lives in Mobile, Alabama. Her AGI for 2016 is $39,623. She did not purchase a motor vehicle, boat, aircraft, home, or any home building materials and doesn't have receipts to use the actual method. So she'd like to see what her sales tax deduction would be. So this is how she fills this out. She looks at the optional sales tax table, and you can see that for Alabama, when you have one person, it's going to be $384 in sales tax. This is where she can use the state and local general sales tax deduction. And it's just a worksheet. Most of us don't use these worksheets anyway, but they are available. It does walk you through, asking you if you live in specific states, and walks you right through the process for local. Taxes that you pay are taxes and fees that are not generally deductible. Federal taxes, such as your income tax and your Social Security and Medicare, you do not get to deduct those. If you receive a license, like a driver's license, a marriage license, hunting or pet licenses, those are not considered to be taxes. Water and sewer taxes are again not considered to be taxes. Any taxes on alcohol, beverage, cigarettes, and tobacco, any taxes on gasoline or other motor fuels, not considered deductible. Utility taxes, such as telephone, gas, electricity, along with the water and sewer. Any fines or penalties, these are not considered to be taxes. They are just considered to be payments. So while they do call them taxes, they're really use fees with the water and sewer and the utility, because they're based on the amount of use that you put on those systems. So these are not considered deductible taxes. So here we have a type of tax, and again, this is out of your publication 17, for fees and charges. If they are experienced for your trade and business or the producing of income, you can deduct them. It's a matter of where they get deducted. They might be deducted here, but they would be deductible. If it's a general sales tax, you can use that instead of your income tax, but you cannot deduct them if you choose to deduct your regular taxes. Fines and penalties are never deductible. Any fees that are charged that are not expenses, where, for example, car inspection fees, parking, anything like that would not be deductible in this section. So if you pay a parking fee or parking ticket to a municipality, just because you wrote a check to a government does not mean that you can deduct it. That's the key there. Regarding your income taxes, foreign income tax is deductible. State and local income tax is deductible. Any employee contributions to state funds that are listed under contributions to state benefit funds would be deductible. What you cannot deduct is federal. I'm not going to read this whole chart for you. There is more information if you really want to get into the specifics. In general, what we tend to deduct would be your personal property taxes. The portion of the payment that you make to your municipality for car ownership should be split. A portion of it is based on the value of the car, and the other would just be a license fee, a registration fee. The registration fee is not deductible. The actual personal property tax amount is deductible. And then real estate taxes, whether they're state or local or foreign, all of those can be deductible. Also, in many places where you are renting, they do allow for the individuals renting to have a portion of the real estate taxes taken off on their particular tax return. Interest that you paid. You can deduct your home mortgage interest, but this is only if your mortgage is a secured debt. So secured debt is one in which you sign a mortgage or something like that. It makes your ownership in a qualified home security for payment of the debt. So what you're doing here is this is where you have an asset, specifically your home, that is tied to the payment of the debt. And it provides, in the case of a default, that they could take your home from you. Their home can be repossessed, and it needs to be recorded in a deed or something like that. And those recording fees are deductible as a tax that you paid. So the interest that you pay for your home is deductible. You report the interest that you pay here in the interest section. Home mortgage and investment interests are deductible. And there is a way to deduct your mortgage interest is reported on a Form 1098. So this is what it looks like. And in most instances, taxes that you paid as well. If you do not receive a Form 1098, you report the interest paid on line 11 instead of on line 10, and you need to add additional information such as the tax ID number of the person or business that you pay your mortgage to. If you pay points the year that you buy the house, or if you pay points in a refinance, any points that are paid by the seller are deductible by the buyer, because the points that are paid are actually considered a portion of the house. If you pay points to refinance the mortgage, they're generally not deductible in full in the year that you pay them. In most instances, those points can be used to buy down the rate, and you would actually include those points throughout the life of the mortgage as part of the payments, as part of the interest paid. You can report the points that are reported to you on a Form 1098. So if you receive the 1098 and it shows the points on that form, then you would be deducting them in the year that they are reported on the 1098. Mortgage insurance premiums may be deductible for any contracts that are established after January 1st, 2007. So if you've bought a home or refinanced your home and you do have to pay mortgage insurance premiums, and that occurred after 2007, you should find them to be deductible. Interest that you pay that's investment interest, you would deduct the investment interest to the extent that you received investment income. The excess of investment interest can be carried over to future years. Generally, you would use Form 4952 to determine the amount of the deductible interest. Gifts to charity. You report charitable contributions here in the Gifts to Charity section of your Schedule A. Qualified organizations would include religious organizations, nonprofit organizations. These are things that have typically filed with the municipality or the state, indicating the nature of their nonprofit, and they do file formal reports. Organizations that would not qualify, if you give money to an individual, you cannot deduct that even if it is for charitable reasons. Any business organizations, civic leagues and associations, political organizations or candidates, social clubs, foreign organizations, homeowners associations, or communist organizations, you are not allowed to deduct that particular amount. Those are not considered to be recognized or qualified organizations. Gifts to charity, the different types of deductible items, any money that you provide them with is deductible. Dues, fees, and assessments paid to qualified organizations that are above the value of the benefits you receive. So for example, if you have a due that is to a nonprofit and you did not receive any benefit from it, Oftentimes we get, if you donate $100, they'll send you a picture, or if you donate $150, you can get a free ticket to their Christmas function. Well, then what you would want to do is, if the normal ticket to the Christmas function is $20, you would deduct $20 from the amount of your donation that qualified you for the free ticket. Used clothing and furniture that's in good or like new condition. Cost and upkeep of uniforms for individuals that are participating in a charity. Unreimbursed transportation expenses. So if you are driving on behalf of a charity, I have several friends who participate in rescues for animals, most specifically some dogs. So they will actually pick up a dog from one location and drive the dog to another location where they have temporary housing for that dog. All of that transportation would be deductible, assuming that they're not being reimbursed by the organization for which they're driving. And the part of the contribution that's above the fair market value. So we're going to look at this again. Non-deductible things would be if you buy a raffle ticket, you're participating in a 50-50 and you lose, that's not considered a charitable donation. Any tuition to a nonprofit school would not be considered a donation, a charitable gift. The value of your time or service. I get this question a lot. Somebody will say, well, I'm a photographer and I charge $1,000 a day to do event photography, but I want to donate my time. Here's how that works. You can't donate your time and take the money off, because if they paid you and you gave them the money back, that would be a wash. So if they paid you the $1,000 and then you said, no, don't pay me the $1,000, here, you can have the money back. In that instance, it would be a wash, because you would put $1,000 on your income level and then you would take $1,000 off on your deduction level. So this is the reason why the value of your time or service is not considered to be deductible. Blood donated to a blood bank or Red Cross, car depreciation insurance or general repairs or maintenance on a vehicle, direct contributions to an individual, sickness or burial expenses for members of a fraternal society. So let's say that you belong to a social sorority and there was a request for everybody to contribute for somebody's burial expenses. That would just simply be something that you did out as a gift. It would not be considered a charitable donation. The part of the contribution that personally benefits you, again, going back to the Christmas tickets. The fair market value of any property that you give to a charitable donation can be deducted, and it's determined on the date of the gift. If the property has increased in value during the time you own it, deduct your basis in it as the property's fair market value on the date of the gift. If it is decreased in value during the time you own it, you would usually deduct the fair market value. So for example, if you have a refrigerator and you paid $750 for it, and now the refrigerator is basically worth $150 when you donate it, then you would deduct the $150, not the $750. If, on the other hand, you bought I'm trying to think where it would go the other way, where it would increase in value. Let's say that you owned land and you bought this land for $10,000, and now that land is valued at $20,000, and you want to give that land to your church for a campground or something. You would only be able to deduct your basis in it because you only paid $10,000 for it. So that's what that is trying to explain. Clothing or household items that are donated must be in good used condition. Also, there's a limit. If you donate more than $500, if there's any particular item that's more than $500, you need to have a qualified appraisal on it. Also, if you donate more than $500, you need to fill out additional paperwork with your Schedule A, being very specific about the items that you donated, the date you donated them, and the organization. If you have a used vehicle, boat, airplane, and you're going to donate that, you would need to provide a acknowledgement, a written acknowledgement from the organization. And that deduction is usually the smaller of the fair market value on the date of the contribution or the gross proceeds received from the sale. So if you donated a vehicle that's Blue Book value was $1,200 and they sold it at an auction for $200, you would only be able to deduct the $200 as a charitable donation. The deduction is not limited if the organization gives or sells the vehicle to a needy individual. So if you, same deal, you take that $1,200 Blue Book car, you give it to an organization who actually gives your car to someone. In that instance, you would deduct the full value according to the Blue Book. And that's what they're saying, used car guide. Kelley Blue Book is available online now. Non-cash contributions to charity, this is what I was just telling you about. If your donations are over $500, you do need to provide additional information regarding the donated property. That includes the name and address of the organization. It includes how you determined the value, as well as a detailed description of the property. There can be limits on deductions. The amount of deduction can be limited to 20, 30, or 50% of the AGI, depending on the type of property and the type of charitable organization. In the event that you reach that limit, you can carry over contributions exceeding your AGI limit and deduct the excess in each of the next 5 years or until it's used up. Record keeping. If your charitable donation is under $250, your proof can be a canceled check or receipt. If it's more than $250, then the organization to whom you donated will need to provide you proof of written acknowledgement. In the instances of most churches, you do receive a statement at the end of the year. That's based off of, donation envelopes or something that tracks it back to you if you're providing them with cash. Otherwise, canceled checks are always a good idea. Where it says other miscellaneous deductions, a couple of those would be gambling losses or the repayments of more than $3,000 under a claim of right. So if you have something that you have to provide someone else and you are paying, such as the gambling losses, you would include that here on line 28. So Joey won $1,000 in the state lottery drawing. He also won $50 playing bingo, but he spent $3,000 on lottery tickets and $10 on bingo cards. Can he deduct any of his gambling losses if he itemizes his deductions? If so, how much? So he won $1,000 and he won $50. So the answer would be yes, $1,050. So he can deduct what he paid in to the extent of his winnings. You could be subject to a limit on certain itemized deductions if your AGI is more than $311,000 if you're married filing jointly, $285,350 for head of household, $259,400 if single, or $155,650 if you're married filing separately. Limit on itemized deductions are subject to the limit of the taxes paid, interest paid, gifts to charity, job expenses, and certain miscellaneous deductions. So that's where you would see those deduction limits. You would not be hit with any kind of a deduction limit as it relates to medical and dental expenses or investment interest, any casualty, theft and loss, or gambling losses. Those would not be limited regarding your AGI. So again, the information from this course comes from publication 17. If you have any questions, please feel free to go to our website at freedomfinancialpartnersllc.com. And again, I'm Ginger Garvey, and thank you so much for participating. And please feel free to subscribe to get the next updates. Next sessions will be on credits. Thank you. Have a great day.